Well, good evening, everyone. Welcome, welcome to this little session. My name is David Etienne from Etienne Business Solutions. For a lot of you, we are familiar faces, and I welcome any other new person who have decided to join us this afternoon. So, as usual, what we try to do at the beginning of each tax season is to look at some of the changes, some of the new developments, basically some of the things that we consider as being critical for you to be aware of prior to going to have your taxes prepared. It is true that modern times, so tax softwares have built-in formulas and built-in, the programming will take care of most of the changes. So the question is, why would I as a taxpayer need to know this and that? Because when I go to my tax preparer, he or she will enter the necessary data, whatever, and I will get what is due to me. But my response to that is when you have your taxes prepared and you're given your copy, it is your tax returns. You owe it to yourself to take a careful look at that completed return and ascertain or satisfy yourself that what you expect to be reflected thereon is actually there. So unless you are knowledgeable of the things to which you're entitled, the benefits that you can attract for yourself, then you'll be looking at a tax returns and not be able to determine that yes, he or she has done a good job because I'm expecting to get this credit, and when I look at line so and so, I can see the credit. I'm expecting to have this deduction, and so when I look at so and so, I see the deduction. So the only way you would be able to critique that tax returns to your satisfaction is naturally if you're aware of what you're to be looking for. Now, the tax changes are numerous. And if one should try to go to the literature, the official, IRS literature to look at all the changes, then yes, you would be overwhelmed. So what we try to do is to extract those components that I consider to be, you may want to say salient, most recurring. So in other words, I would imagine there are some things that easily 70 to 80% of taxpayers would be, contending with. So we'll decide to just pull those items, those issues, those matters, and so that those things will form, the content of today's little discussion. The other thing I'll quickly say before we jump right in is that at the beginning of the tax season, it is natural to find taxpayers a bit anxious. You just want to rush to get your taxes done because you want to be in that first round of refunds for various reasons. You may have had some plans and you're waiting on a tax refund to deal with it. Your car may be giving a lot of problems. And you say, okay, I'm waiting until tax time when I get my tax refunds to help me to change this car, whatever the reason is. So the tendency is to try to get to your tax preparer as quickly as possible, get your thing in so you can get your refund very early, sometime in February. Nothing is wrong with that. But a word of caution. In that rush, you're likely to overlook certain critical documents. And those critical documents you may find are coming in through the mail mid-February, end of February, and trust me, sometime even in March because they may be delayed. So you may have received 2, 3, 4 pieces of tax documents and you rush out to have your taxes prepared, overlooking the fact that there may be a form here and a form there that is yet to arrive. And so you have your taxes prepared with incomplete information. It may be to your disadvantage to have that happening. But more critical, to the extent that any omitted document has to do with additional income that would have not been reported, then you're running into a very, very sticky position, because there's a penalty. There's a penalty for underreporting income. There's a penalty for underreporting income. So if you were to receive 3 W-2s because you worked at different places throughout the year, you receive 2, for whatever reason, anxiety, lapse in your memory, you did not get the 3rd, you have your taxes prepared, and then later on that W-2 comes, and maybe it never appeared, but then the IRS would have information, would say to you, you filed your taxes without this documentation, which represents maybe $10,000, $15,000, $20,000 of additional income. So right away you have underreported, and the IRS will see it as an intentional underreporting of income to evade the tax implication, and that can carry a heavy penalty. So for all those reasons and others, you need to just be calm, be proactive, be patient, so that you actually go to your tax preparer with all the necessary documentation that you should have. Good. Having said that, at the end of this session, you may have questions that pop up in your mind, but there's an email that we're set up to receive all those questions. That is seminars at myebsolutions.com. Seminars at E as in Edward, B as in boy, solutions.com. So I'll definitely be looking at at this email to see if there are questions that you are seeking answers to. Having said that, let's jump right into our little discussion. Now, topical for all of 2021, I would say topical, because this really impacted a lot of people, is this child tax credit. Child tax credit. Yes, you have heard a lot about this child tax credit. And child tax credit is nothing new, because it's something that has been around for quite a while, and taxpayers have been benefiting from the child tax credit. So what is so unique about child tax credit in the context of 2021 tax returns? Two main things. One, for 2021, the child tax credit increased. And so you find that for taxpayers having dependents that are, say, 5 years or younger, 5 years old or younger, then they became entitled, and assuming all other conditions were satisfied to qualify for that credit, they became entitled, so to speak, to $3,000 child tax credit for the year. Now, prior to that, it was $2,000. It had moved to $3,000 for those persons having dependents 5 years or younger, 5-year-old or younger. Well, I'm sorry. The other way around. That $3,000 is really for dependents that are, 17 and, so let's please, I stand corrected, 17 and younger. Taxpayers having dependents that are 17 years old or younger qualified for a $3,000 child tax credit for the year. Now, those whose dependents were 5 years or younger, they qualified for $3,600. So effectively, 3,000, 17 or younger dependent, $3,600 for dependents 5 years old or younger. So that is one thing. There was an increase, and that was very good. The other component to the child tax credit is that because of the whole COVID and people needing money, one of the ways of trying to get money into people's hands is to say, okay, whereas normally taxpayers would have to wait until tax time to file your taxes, and then you would benefit from whatever child tax credit to which you're entitled. For 2021, the decision was made that you'll be given advance distributions of this credit ahead of tax preparation time. So for those who qualified for the 3,000, that when divided by 12 months ended up giving you $250 per month. For those who qualified for the $3,600, then that converts to $300 per month. So some taxpayers would have been receiving $250 per child month over month. Others would have been receiving $300 per month as child tax credit, depending on where you fall. So those were advanced child tax credit. It was optional, however, because you could have gone onto the IRS website and what they refer to as opt out of it. Say, okay, I don't want any, during the year distributions. I'll wait until tax time so that I can get the full. Well, most persons I would imagine went ahead and was receiving those monthly distributions. So that's the critical thing. Now, linking this to my opening remark about ensuring to have your documentation all documented before going to file your tax returns, be mindful that you will receive a letter from the IRS, and the IRS is, as I said, a forms institution that uses a lot of numbers and codes. But anyhow, this is letter 6419. That's what a code is for the letter. That letter is the document that indicates to you how much advanced child tax credit was disbursed to you during the year 2021. And remember now, the distributions started about mid-year 2021, somewhere in July. So you'd have had distributions from July to the end of the year, December 2021. So that letter, 6419, indicates how much advanced credit you were given between that July to December for that half year. That you will take to your tax preparer, who will now enter that information, which will show, okay, you have received this amount. And so, because you're entitled to a full 12 months of child tax credit, having received 6 months or half of that, then the other 6 months or the other half of the year's child tax credit will naturally flow on your tax returns in the normal way as it used to in past years, when that is where you would normally get all your tax credits, your child tax credits. So just to reemphasize, you would have received half of the year's allocation between July 2021 to December 2021. And when you file your taxes, you report what you've already received, and then the balance will be part of your 2021 tax result. Remember now, people, there are two things here that you need to be mindful of. One is this child tax credit matter. The other has to do with this COVID-related distribution from retirement income. But I'm going to come to that later on. What I want to emphasize is this. Your entitlement to the child tax credit was based either on the information that was on your 2019 tax returns or the information that was on your 2020 tax returns. So depending on number of dependents, the age of dependents you had on either 2019 or 2020 taxes, the IRS is using that information to determine whether or not you're entitled to child tax credit, and of course, how much you're entitled to. Now, you receive your letter 6419. It indicates that you have received X amount of dollars for advanced child tax credit. So if in 2021 you go to file your taxes and the dependent or dependents that you had on your 2019 tax returns and or on your 2020 tax returns is not reflected on your 2021 tax returns, then you see the problem right away. You were given this advanced child tax credit, and that was predicated on an assumption that whatever information is on 2019 or 2020 in terms of dependence would continue to be the case for 2021. So you're given advance. Now come 2021 taxes, when we look at it, zero dependent. What do you think happened? You have received half year of child tax credit advances to which you are not entitled. So right away, you see what's going to happen. In the process of preparing your tax returns, then there's going to be some recovery of that advance. Okay, so that's a little potential horror story. The other related aspect is that, let us say year over year you're accustomed to receiving $2,000, $3,000, $4,000 as your tax refund. This time when you file your taxes, all other things remaining the same, you may find that you only receive $1,500, $1,800 refund, and you're wondering what on earth is happening. But it's because you're forgetting that a large part of your tax refund would have been your child tax credit. But this time for 2021, you've already received 6 months of that credit as advance. So to see what is your true tax refund, so to speak, you have to take that $1,800 received on your tax returns and add all those advance credit that was sent out to you to see what is the true picture. So do not go ahead banking on, changing your car because you're going to get $4,000 for tax refund. Bear in mind that even if that was the case in past years, this year you had already gotten some of the money upfront. Okay, so I just thought that I would just alert you to that, because I know a lot of people are going to say, oh boy, to your tax preparer, this must be wrong. You must have made a mistake. We all make mistake. That is the cause behind it. Good. So that is very important. Child tax credit, okay? Increasing amounts and the changes. So look out for that in 2021. Let's jump to unemployment benefits. Unemployment benefits naturally and as usual were always taxable income. That is the norm. Unemployment benefits is taxable income. However, for 2020, it was decided that to give you some relief, $10,200 of unemployment payouts or benefits was treated as non-taxable. So you recall that. So you received a letter that exempted $10,200 from taxes. And in the event that you had already prepared your tax returns before that announcement was made, or that determination was made, then you would have received a subsequent refund to take care of the fact that $10,200 was non-tax. That was for 2020. That did not continue in 2021. For those who have received unemployment benefits in 2021, that $10,200 non-taxable portion is not applicable to the 2021. It was only for that 2020 period. Okay, so as for the year 2021 onwards, it goes back to where we have all dollars paid out as unemployment benefit being taxable money. We jump again. I just want to cover quite a bit, so we're just moving very quickly. Again, we look at what we refer to as the rebate cover, the recovery, the recovery rebate credit. That's what it's called. The stimulus payment that you got, $600, $1,200, $2,400, $1,400, you name it. When you go to prepare your taxes, your tax preparer normally say, okay, did you receive the stimulus payments? And if you did, how much did you get for the first drawdown, the second drawdown, etc.? Why is that important? It is because for those who, for one reason or the other, did not receive it as a direct disbursement, but are entitled to it, then you have an opportunity to claim it on your tax returns, okay? Now, here's where you need to be careful. When your tax preparer say to you, did you receive the second stimulus money? And you're saying, I'm trying to remember. I don't think so. Tell you what, no, I didn't receive it. You know what's going to happen? The tax preparer is going to indicate 0 received for the second stimulus. By doing that, the tax computation is going to show that you did not receive it, so we need to include it in the tax returns. So let us say at the end of the day, the tax returns end up showing $2,000 refund. But when the taxes are e-filed and it goes into the system will identify that, we had already paid out this second installment. So this tax return saying, no, it was not received, and therefore it is not included in your refund, is incorrect. So it will recalculate and decide, no, he or she already got that. So you were expecting that $2,000, but then you end up with nothing or maybe even owing. Because to the extent that your refund would have been less than that figure for the second installment that you say you did not get, by recovering that money from the tax refund, you utilize all the potential refund and still end up owing some money. All right. So again, you need to ensure you have your information. So when your tax preparer say, how much money did you receive for disbursement 1, 2, 3, or 4, whatever the case is, then you're able to answer correctly. All right. Something I should just jump back to before moving on, back to that child tax credit issue. I mentioned that where it is determined that you were overpaid, child tax credit, then it will be recovered. Of course, there's a provision here for you to be given almost like a waiver. Okay, certain criteria could result in you getting a waiver where you may not have to pay back any of this overpayment, or you may not have to pay back all, maybe just a portion of the over based on certain variables, which of course your tax preparer will get into more details on. But back to unemployed, back to the recovery rebate credit. That is it. You need to have firm information, correct. Let's go back. If it was a check, look at the deposit you made to your bank account. If it was a direct deposit from the IRS, also look back at your bank statement and give the correct answer, so you don't run into that potential great disappointment. Okay, that's recovery rebate credit. We come now to distribution from retirement accounts. And you recall in 2020, the understanding is this. Whereas any withdrawal from your retirement account before you reach the age of 59 and a half years old has two implications. One is a tax that is due on the amount taken, and also an additional 10% penalty for what is referred to as early withdrawal. That was standard. The tax and the penalty. Okay. So for 2020, what happened is that the provision was there that any, and they call it COVID related, any COVID related withdrawal from your retirement account in the year 2020 up to $100,000 had that 10% early withdrawal penalty waived. You still had to pay the taxes on the withdrawal. It's a must. But that early withdrawal penalty that would have occurred if you withdrew prior to you being 59 and a half years old, that was waived. Only for disbursements or distributions taken in the year 2020. It did not extend to 2021. So if you had reasons to still go back and take more money from your retirement account because, of course, COVID continued, then bear in mind that you will definitely be faced not only with the tax implication, which is a must, but you also have to deal now with that early withdrawal penalty, assuming that you are less than this 59 and a half years old as stipulated. Okay, that's another change now. So look out for that. Look out for that. Another element of this withdrawal is this. If you recall, you were given an option that when you took this, remember I said no, the penalty was waived, but the tax had to be paid. So you're given the option to pay all the taxes due on that withdrawal in the year 2020, or alternately, you're allowed to spread the tax burden over a 3-year period. So you were allowed to do 1/3 in 2020. And if you took up that offer, you'd have done 1/3 in 2020, 1/3 in 2021, 1/3 in 2022. So your 2020 tax returns would have only reflected 1/3 of the withdrawal that you made from your retirement account. And therefore, your tax returns for 2020 would have only been impacted by 1/3 of the total taxes due. So when you go to prepare your 2020 taxes now, 2021, you're preparing 2020, 2022 now, you're preparing your 2021 taxes, then realize that the second third of that arrangement is due to be addressed. So again, that could impact, well, that will impact the refund that you end up with. But just like that advanced child tax credit, if you're accustomed to getting a certain ballpark figure, you need to realize that, okay, I must be mindful that there's a tax hit I'm going to get in this tax year that is related to that distribution of prior year. Okay, and as we indicated, that would have been the second third. So for 2022, you will then face the third, and that would be complete. So look out for that, so that again you don't have any unpleasant surprise. Okay. No, this lends itself to a little bit of tax planning, but I'll just mention it briefly because this is really historical now. What we're saying is that at the time of you trying to make a decision, should I go with the one third, or should I just hit the tax one time? That decision primarily would be primarily based on some planning. For example, if you know that, all right, in 2021, 2022, my income is going to be, going to significantly increase, you might say, you know what, I'm already going to have a heavy tax bill, then I don't want to be burdened with this. So let me just deal with all of the retirement money taxes upfront, and then, and then just deal with other income tax matters at a later point. So that, again, very important for us to look at. Still on the matter of retirement monies, when you take distribution from your retirement income, you are allowed what is referred to as a rollover, meaning you are given up to 60 days where if you then redirect this money you took into a retirement account, then you are allowed to treat it as a rollover. It is not treated as a distribution. So what happened? You end up not having to pay the early distribution penalty because they treat it as a rollover. But it has to be done within 60 days. Now, for under the COVID relief, they're saying no, we'll waive that. So you have up to 3 years for you to roll over that distribution you got in 2020, and it will still be treated as rollover, although it is way past that 60-day, which is the norm. All right, so you have that arrangement to make. So can I get a cup, please? Yeah, just a empty cup. Okay. Yeah. So that is one of the things that you need to be mindful of, that there is that provision. Okay, there's that provision. So that 60-day, as I said, is a norm. That 60 days is a norm, but of course the 3 years is the time you have to roll over that 2020 distribution. Good. If at the end of the 3 years, you fail to roll over all of that distribution that you are given, then what will happen is any amount that is not deposited into another retirement account will now be treated as an early distribution. All right, so that is very important to know. 60 days is a norm. You have 3 years to do it to still qualify for that 60-day arrangement. But if you have anything, you see me laughing, if you have anything that is left unrolled over, so to speak, at the end of 60 days, then that is going to be treated as early distribution. And that early distribution will definitely have tax implication. Okay? Simply put. Why am I laughing? You know why I'm laughing? You would never in a million years guess why I'm laughing. But I'm laughing because I can definitely see, and this is what I see. where a person with the best intention in the world will say, yeah, man, I have 3 years and I will definitely roll it over or redistribute it in the 3 years. But you'd be surprised. Once you have used that money, it's the most difficult thing for you to really find it back to put it into some new retirement account. So what happened is that you end up at the end of year 3, find that you have a lot of money that is yet to be put back into a retirement account, and so hit with early distribution penalty. And you all this while you thought, oh man, I have 3 years, I don't have to rush it now, and before you know it, yeah, the time is passed, and so you're caught. Okay, so that was that. Still on the topic of retirement money distribution. Now, there's what we call a required minimum distribution. Required minimum distribution. Required minimum distribution states that once you are 72 years old, once you have reached 72 years old, then you are required by law to take a distribution from your retirement account. Okay, it's a required minimum distribution. You have to start taking some money from your retirement account. Not to do that is to face a penalty. And you may say, that is interesting. How could I be penalized for not taking money from my own account? But that's how it works. But again, in 2020, a relief was granted to say, all right, we will, as in the IRS decide, they will waive that penalty if you fail to take the required distribution. They will waive it. They will not penalize you. But that was only for 2020. Again, once we jump into 2021, it states that you need to take, failure to take that required minimum distribution is going to end up with some penalty. Okay, so be aware of that. Now, I indicated earlier that some of these things I'm mentioning, you're asking, okay, it's not of much use now because this is after the fact, and it is true. Some things you should have already taken these steps, But one would have hoped, One would have hoped that last year when you were dealing with your taxes, that your tax preparer would have advised you and say, okay, this is how it's work. This is how it's going to play out in 2021. So with that in mind, we need to properly plan for it. So to the extent that you had planned for these things, then me mentioning them here is just for you to say, hip hip hooray, yes, I'm covered, I'm good, I did what I needed to do. Or to the extent that as you listen to me, you're realizing, oh my goodness, I did not do that, then at least you will be aware that you need to brace yourself and maybe adjust your plans accordingly, because you're not aware that, hey, some things may just come to hurt me that I was not even expecting because I did not know beforehand. So that is your required minimum distribution. Good. Let's touch on student loan. Student loan. Student loan. Specifically, student loan forgiveness. Now, whenever you owe a debt, and the common one is like a credit card bill, but student loan also will fall in the same category for what I'm about to speak to. So whenever you owe this debt and you are forgiven, okay, you're forgiven the debt, someone say, okay, you no longer have to pay it, we will just overlook it. Although you are relieved from having to pay that debt up front, there is some implication to that on the back end, because any amount of debt that is forgiven is now treated as income to you. So for example, if you have a balance on your credit card of say $10,000, you cannot pay it, you go to your credit card company and you say, man, I need to, whatever. Can you forgive this thing? And they say, okay, yeah, let's get rid of it. So they forgive that bill, that debt, but they report it, to the authorities, to the IRS. So the IRS will know, so you now receive a form that says you have been forgiven $10,000 of credit card debt. But that $10,000 is now treated as taxable income to you. So yes, you will not have to pay the full $10,000. But assuming that you have a 10% hit, then you would have to pay, did I say $1,000? because 10% of 10,000 is 1,000. So you still have that tax piece to deal with. Let's jump back to student loan. Student loan forgiveness was always treated in that manner. If you're forgiven the student loan, mean that you do not have to pay it back, but then it becomes taxable income to you. That's a norm. In 2020, it was decided, okay, we will not make it to be taxable income. Okay, we will not make I'm sorry, this one for 2021. As of 2021, it was decided that it may change, but between say 2021 and up to 2025, that's a period where any forgiveness, any student loan that is forgiven will not be converted into taxable income. So you must get the forgiveness, that's it. It will not be showing up on your tax returns for you to have to pay some taxes. All right. So that again is something that's worth it to note. And that came about in 2021. So I suppose some individuals who received a forgiveness of their student loan in 2020 and before are now saying, oh my goodness, if only I had received that forgiveness in 2021 onwards, then it would have become a forgotten matter. It would not have been converted to taxable income. That is the full forgiveness. Now, there's another aspect of the student loan where your employer, so you're working at company A and your employer decide that they're going to assist you to repay your student loan. They're going to assist you to repay your student loan. Okay? Again, prior to 2020, the extent to which your employer assisted you in repaying your student loan, that was treated as taxable income to you. So your employer paid $10,000 on your behalf, okay? Then that $10,000 was now treated as you receiving $10,000 of income, which had to be taxed in the normal way. As of 2020, and this goes right through to 2025 also, only a portion of that employer assistance is going to be treated as taxable income. So up to $5,250 is exempted from being converted into taxable income. So let's say your employer assisted you to the tune of $10,000, then $5,250 of that $10,000 will not be treated as taxable income to you. It's just the difference, the balance of 4,000, whatever that figure is, okay, will be treated. That again is a relief. That one is from 2020 through to 2025, whereas the full forgiveness, student loan forgiveness that we mentioned earlier on, is really from 2021 through to 2025. Okay, a student loan forgiveness and student loan assistance. We jump to charitable contributions. Prior to last year, prior to 2020, one would only benefit from charitable contribution as a deduction if you itemized. If you prepare a Schedule A on your tax returns where you show all your itemized deductions. If you always use your standard deduction, then there was no opportunity for you to benefit from any charitable contributions that you make. In 2020, that was changed, where they say even for those who do not itemize but go for the standard deduction, there was still a provision where you could get up to $300 as a charitable contribution deduction on your tax returns, although you had not itemized and was using the standard deduction. That was $300 on each tax returns. As of 2021, there's a change where it's not $300 per tax returns, it's $300 per taxpayer on the return. So if you have a joint tax returns, yourself and spouse, you now have a $600 deduction for charitable contribution. Up to 2020, it was a case where with a single, joint, head of household, whatever, you were getting that fixed $300. Now they're saying naturally, if it's still a single tax return, then you're going to get your 300 in your own right. But if you file a joint tax returns, then there's going to be $300 for each person on the return. That's yourself and spouse. So we talk about $600. $600, you know. Yeah. So that is it for that charitable contributions. Now, when it comes to the standard deductions, every year there's a marginal, change. Not every year, but so quite, very often there's a change. So for 2021, the standard deductions saw a bit of increase. And just a quick recap. Remember now, the standard deduction, basically, in the simplest form or explanation, is where you have this total income, but before subjecting it to the whole taxation process, a portion is taken out and it's referred to as a standard deduction, and that portion is taken out and the balance is put through that tax mill. So basically, you get a little reprieve, a little exemption, a little relief from the total tax, the total income being taxed. So that is your standard deductions. And naturally, every filing status, whether it be single, head of household, married filing jointly, you name it, will have a standard deduction figure applicable to that status. And that is what you would have. So because that figure has increased somewhat for 2021, then you stand to maybe marginally, yes, but you stand to maybe benefit by a couple dollars more. Same thing with the tax brackets. The tax brackets are raised. So the bracket has a minimum and it has a maximum, and there's a range in that bracket. And so once they raise it, it means that the amount of the figure at the top end of this bracket is now a little greater. Before it was raised, if your income went up from this point to the next, you may find that you jump out of this tax bracket into the next tax bracket. But if they have extended the upper level of this tax bracket, it means that your income can move from here to here and you're still in the same tax bracket. So that's the benefit of having an expansion in the tax brackets. Allow you a little more upward movement in your income while still allowing you to remain in the same tax bracket, right? The earned income credit, again, is another one where, yes, it is based on your income and other variables. And so you find that there's also an increase in that earned income credit. Okay, so again, it is related to the different filing status of single, head of household, married, etc. So for a single person, it is now $1,502. Okay, and it moved to 3,000. Well, I should say that for you to get your earned income credit, apart from the income, it has to do with you having dependents. So for you having one dependent, then you qualify for that. 1,502, 1,502. Two dependents take us to 3,618. Three dependents to 5,009, and four dependents $6,000. So all those numbers have increased marginally, but it still means that overall it gives you some level of added benefits. So those are what I consider to be the common things. You see, the common things that most tax preparers will confront, because when it comes to credits, spend a brief couple of minutes looking at this credit deduction comparison debate. Important for you as a taxpayer to be comfortable and to understand the difference and how those two impact your tax returns differently. Simply put, your tax credits will always benefit you greater than a deduction. That's always be the case. And here's why. Let's start with a deduction. And I'm going to use some simple numbers. I'm going to try to keep the numbers in my head because I'm known for that, to forget them. So I'm going to start very simple. Let us say that your total income is $100 and you're entitled to a $10 deduction. So what will happen? We take the $100, we deduct the $10, we're left with $90. If you are in the 10% tax bracket, then we're saying that 10% of $90 is $9, and so your tax bill is $9. If you did not have that deduction, you'd have had to tax the whole $100. So 10% of the full $100 would have been $10. So what you notice, that $10 deduction saved you $1 of tax. Very simple numbers. If I tax the full $100 at 10% tax, my tax bill would have been $10. Because I had a $10 deduction that I used to reduce the 100 to 90, when I apply the 10% tax rate to 90, my tax bill is $9. So I've saved myself $1. So a $10 deduction, gave me a $1 benefit. Cool. Let's use the same example. Let us say that I am entitled not to a $10 deduction, but I'm entitled to a $10 credit. Whatever the credit, it's a credit, a tax credit of $10. So follow me. Since I do not have a $10 deduction, it means that the full $100 will be taxed. Because there's no $10 to deduct from it, I have no deductions. So this $100 will have no deductions. So when it comes down here, it is the $100 that's going to be taxed. 10% of that $100 is $10. So $10 is my tax bill. But because I'm entitled to a $10 credit, then what a credit does is to directly reduce your tax bill. So I end up with a tax bill of $10. Then I bring my $10 tax credit to offset it. So I end up having a zero tax bill. Because what happened is that your credit is what we refer to as dollar for dollar. Okay? You get a full dollar for dollar deduction when it's a credit. When it's a deduction, then it actually just reduces your tax bill by a percentage. But a credit is a direct reduction in the bill. Okay, I hope that kind of gives you an idea as to what is happening here. Why is that so important? It is very important because when you go to your tax preparer and you have a lot of deductions, which are things that you put on your Schedule A called itemized deductions, and you have a lot of deductions amounting to $20,000, $30,000, etc. And you're expecting that those deductions, $20,000 worth of deduction, would have a significant impact on your tax returns. And you realize that it's far from what you expected. Yet another person with just $2,000 worth of deductions compared to your $30,000 of deduction only have $2,000 worth of deductions. But that person, by virtue of the fact that they have kids and can get a child tax credit, they're going to school and can get an education credit, you name it. By virtue of the fact that they have credits, they end up, they come out in a much better position than you are. And you're wondering, how could I have $30,000 worth of deductions? This person only had $5,000 worth of deductions, yet he's better off than me. Assume that all other variables are similar. And that's really how credit or credits versus deductions work. Okay, that's really how the thing flows. So a lot of these that we have gone through here, the child tax credit, the earned income credit, you name it, all those things are things that once you qualify for them, they will have a significant impact on the result of your tax returns. Matter of fact, in most instances, I'm just guesstimating that maybe up to 70% thereabout of the typical tax refund for a person with dependents and low income, relatively low income, is really made up of these credits, of the earned income credit, the child's tax credit, and then to maybe a lesser extent, but still occurring, would be where one or two of those dependents are, college age, attending college, and so they get the education credit. All right, that sort of thing. So all those things. So those are the things. Credits are king compared to deductions. Now, I started out by saying this, and I'm going to repeat. Most taxpayers are notorious for not paying much attention to the details on their tax returns. What they want to know is, how much am I getting back? And when they hear the number, if it's a number that makes them happy, they say hippie hooray and they go off. Because that's all the concept about. So in other words, they are not knowledgeable of the information that is reflected on the tax returns. Okay? Bad practice. That's what I'm saying. Bad practice. You will not understand all the intricacies, but you need to be aware of the things that are on your tax returns. And you need to satisfy yourself that they reflect what you know are the things that you're involved in during the year, whether it be income sources, whether it be expenses, etc., etc. Very important. So take some time, look at your tax returns. Okay? Let me again go back to an earlier statement. I said to you, be careful to ensure that you have gathered all your tax documents before heading off to your preparer. One of the main reasons that you do not want to go have your taxes prepared, omitting a critical income document, a W-2, a 1099, a dividend statement, you name it. You do not want to go to your tax preparer without a critical and maybe significant sum on an income document, because that could cause you to be penalized for under-reporting your income. And this under-reporting penalty can either be $5,000 or just about 10% of the unreported income. Okay, 10% of the unreported income of $5,000. So it can be significant. So you want to be very careful. Now, so if you notice, this is from the income side of you overlooking certain documents. Let's go to the other side of the coin. Let's assume that the income that you overlooked was income reflected on what we call a 1099 form. And you know, the 1099 form is what a contractor will receive to show income earned. And just like how the 1099 shows the income that the contractor earns, in the same breath, the contractor, in preparing his tax returns, is allowed to take a lot of business-related deductions because he had to spend money in order to earn this money reflected on the 1099. So the 1099 shows his income, but then he's allowed to take all the work-related expenses that he incurred. So here where I'm going with this. So you prepare your tax returns and you had other income sources, but you inadvertently overlooked, missed, did not report that 1099 income. And again, let's use that $10,000. On it is $10,000. So the IRS writes you and say, okay, the information we have on file does not match what is on your tax returns. We have this 1099 that you had not reported. And so they go right ahead and just calculate the tax that would be due on that $10,000. Follow me? They are calculating the taxes due on that unreported $10,000 without any deductions made against the 10,000. So they are applying a tax rate to the 10,000. had you received that $10,000 1099 and put it on your tax returns as income, then you would have proceeded to deduct expenses incurred related to the earning of that $10,000. But the IRS is not going to call you up and say, oh, by the way, I see a 1099 here with $10,000 income on it that you have reported. We're about to calculate the taxes on that income, but we're just checking to see what kind of deductions you may have that you want to advise us of. Why would they want to do that? It is in their interest to just apply taxes to the $10,000 without any deductions. Now, when you get that bill and it says you owe X dollars, you're going to say, oh no, this is incorrect because I have deductions against this 10,000. And so you say, I'm going to prepare an amended return and I'm going to include the 10,000 and I'm going to put all the necessary deductions that I know I have. Yeah, you can do that. But what you have done now is to open yourself to a potential audit, meaning because you are now submitting this and now introducing these new expenses that you had not included in the original tax returns, then it is likely that the IRS will say, okay, you need to bring me all the proof, all the invoices, all the documentation to show me every last penny of these expenses that you are now claiming on an amended returns that was not reflected on the original returns. Because they want to know if you're just making up some numbers to offset the tax bill on this unreported income, or if it is really legitimate expenses. So again, you rushing off to get your taxes prepared and overlooking documents can, on the one hand, have implication for you being hit with underreporting penalty, underreporting of income. And on the other side, you doing that, you effectively deny yourself of the ability to do what you could do in terms of taking your deductions. Okay? Very, 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 very important. Very important. I said we are anxious to get our taxes done. We're anxious to get things moving, but you need to be cognizant of that. Great. So I think yes, we plan to have just hour. It's exactly at 7 p.m. now. So we're keeping to the time. But these are the couple of things that I thought that it is worthwhile to bring to your attention and for you to be looking out for. The little discussion here may stir up some questions in your mind. And so again, seminars at myebsolutions.com is where you can send your questions to do with, what we've discussed this afternoon or any other tax matter, because it's now the tax season and you will more than likely have questions maybe on issues and matters that we have not touched this afternoon. So I hope and trust that this little hour spent will help you to better understand, to better prepare, okay? Because as I say, knowledge is power, and every little bit goes into giving you what we refer to as a favorable tax returns. So thank you once again for hanging out with me. I'm David Etienne from Etienne Business Solutions. You can find us online, and I also invite you to subscribe to my YouTube channel, because there is called Etienne's Place. Etienne's Place. Okay. There you will find a series of video that we have posted to do with a wide cross section of business subjects, from taxes to finance to investment, you name it, business development, financial statement, budgets, all of that. So I think you will find them to be quite useful. So subscribe, check them out, and do not hesitate to send us your questions in that to that email address. And yes, we are right in the heat of the tax season, but still a little breather. So I promise that before it gets too crazy, we can certainly turn our attention to your questions and hopefully give you some quick answers. And as a parting shot, you may have seen it on our advertisements that we offer free 30-minute consultation, no obligations, just, you just call and we have a 30 minutes discussion on whatever is topical for you, where we lend some advice and some guidance as to how you could go about navigating certain business challenges. All right. So you call through, we have our phone consultations. Pre-COVID, we would have some in-office consultations. Yes, we're not having that anymore. But hey, you don't need to be looking at me for us to have a meaningful discussion. So give us a call for your 30-minute free consultation. Send us your questions at seminars to seminars at MyEB Solutions, and we'll be in touch. So once again, thank you.